Based on analyses from financial institutions, venture capital firms, and regulatory experts, 2026 is expected to be a pivotal year where Bitcoin becomes integrated into the traditional financial system rather than operating on its fringes. The news centers on three massive shifts: major regulatory clarity, an explosion of institutional products, and evolving market dynamics. The Great Regulatory Shift. The legal landscape for crypto in the U.S. is set for its most significant transformation. The Clarity Act, a landmark bill, the Digital Asset Market Clarity Act, is anticipated for a Senate vote by January 2026 after clearing the House. Its goal is to end the long-standing uncertainty by defining clear rules and dividing oversight between the Securities and Exchange Commission, or SEC, and the Commodity Futures Trading Commission, or CFTC. This is expected to unlock massive institutional investment, a new era of SEC-CFTC cooperation. The historical turf war between the SEC and CFTC is officially over. They are now working cooperatively, issuing joint guidance and streamlining rules. The SEC is focusing on a token taxonomy to clarify which assets are securities, while the CFTC is stepping into a more powerful role overseeing core commodities like Bitcoin. Stablecoins go legit. The Genius Act, passed in July 2025, establishes the first federal regulatory framework for payment stablecoins. Final rules are due by July 2026, paving the way for banks and major payment networks like JP Morgan, PayPal, Visa, and MasterCard to fully adopt them. Analysts forecast stablecoin circulation could triple to over $1 trillion by 2026. The institutional floodgates open. With clearer rules, Wall Street's engagement is shifting from experimentation to full-scale integration. The ETF Palooza. Following the success of spot Bitcoin ETFs, the SEC has streamlined the approval process. Over 125 crypto ETF filings were awaiting approval as of mid-December 2025. Analysts project more than 100 new spot, multi-asset, and leveraged crypto ETFs could launch in 2026, potentially driving over $50 billion in new inflows. Banks enter the arena. Traditional finance is building crypto directly into its services. Major banks are developing products for crypto trading, custody, and lending. JP Morgan, for example, has plans to accept Bitcoin and Ether as collateral. Corporate balance sheets and M&A, holding Bitcoin on corporate treasuries is now mainstream, with at least 172 public companies participating. Furthermore, mergers and acquisitions are at an all-time high as companies race to build full-service crypto banks. Bitcoin's new market reality. The fundamental drivers of Bitcoin's market are changing in the face of this institutional wave. A major theme from analysts is that Bitcoin's classic four-year halving boom and bust cycle is becoming obsolete as patient institutional capital via ETFs and corporations absorbs more supply than is newly mined. Bitcoin is expected to transition to a more stable upward trajectory, what Grayscale calls the dawn of the institutional era. Volatility compression. This new ownership structure is changing Bitcoin's behavior. Recent price drawdowns have been shallower, around 30%, compared to historical crashes of 60% or more, signaling it is starting to behave more like a mature financial asset. Divided price predictions. Despite the bullish structural trends, price forecasts for late 2026 are extremely divided, reflecting market uncertainty. Bullish case, some analysts see Bitcoin reaching a new all-time high in the first half of 2026, with targets ranging from $100,000 to $250,000. Bearish case, others warn of an extreme bear market, arguing that the 2024-2025 rally, fueled by political hype, may have been as good as it gets for this cycle. In summary, the most authentic prediction for 2026 is not about a specific price point, but a fundamental change in Bitcoin's role.
The combination of landmark legislation, cooperative regulators, and an influx of institutional products is set to transform Bitcoin from a volatile speculative asset into an integrated component of the global financial system.
Building on the overview, the impact of 2026's regulatory and institutional shifts will play out across three main areas: investment products and personal finance, business operations, and corporate strategy. For investors and individuals, the regulatory clarity and institutional integration mean easier and potentially safer avenues for crypto exposure, but with new considerations. Access to mainstream products. Expect an explosion of new investment vehicles. Following spot Bitcoin and Ethereum ETFs, analysts predict over 100 new crypto-linked ETFs could launch in 2026, offering diversified exposure. New on-chain vaults, sometimes called ETFs 2.0, are also expected to grow significantly. For accredited investors, more venture capital funds are flowing into crypto startups, focusing on institutional-grade products. Changing risk and volatility profile. Bitcoin is expected to become less volatile as institutional capital provides stability. Some analysts even predict it will be less volatile than stocks like Nvidia. However, this institutional dominance also means prices may be more sensitive to macroeconomic factors, like U.S. Federal Reserve interest rate decisions. The classic 4-year boom and bust cycle driven by retail speculation is widely considered obsolete. Security and compliance become paramount. As regulation tightens, using compliant, regulated platforms and custodians will be crucial. Major security breaches in 2025 highlight ongoing risks. Investors should prioritize platforms that adhere to new rules like the Genius Act for stablecoins and demonstrate robust Know Your Customer (KYC) and anti-money laundering (AML) procedures. For businesses and corporations, crypto is transitioning from a speculative asset to a functional tool for treasury management and payments. Treasury management and financing. Holding Bitcoin on corporate balance sheets is now a mainstream strategy for diversification and as a potential hedge against currency devaluation. More importantly, crypto is becoming usable capital. Major banks like JP Morgan plan to accept Bitcoin and Ether as collateral for loans, allowing companies to leverage holdings without selling them. New digital asset treasury (DAT) companies have emerged, though their market role is still evolving. Operational efficiency with stablecoins. The Genius Act provides a federal framework for compliant stablecoins, accelerating their enterprise use. Businesses can use them for faster, cheaper payments and settlements, especially cross-border. Mergers, acquisitions, and crypto banks. Aggressive consolidation is expected to continue. Crypto companies are acquiring others to build vertically integrated, full-stack platforms that offer everything from trading to custody, effectively becoming crypto banks. Simultaneously, traditional financial institutions are accelerating their own crypto offerings, often through partnerships or acquisitions, making build versus buy a key strategic question. A favorable capital environment. Venture capital investment rebounded strongly in 2025, with larger checks going to fewer, more mature companies. This trend is expected to continue in 2026, favoring startups with clear, institutional-grade products and business models over pure speculation. Navigating a global regulatory patchwork. While the U.S. moves towards clarity, global implementation is uneven. The EU's MiCA regulation is in effect but facing teething problems. Asia-Pacific markets are advancing at different speeds. Companies operating globally must navigate this complex, fragmented landscape, with compliance becoming a significant operational focus, especially concerning financial crime prevention. In short, 2026 is about moving from theory to practice. For all participants, success will depend less on short-term speculation and more on understanding and integrating these new structural rules of the game. To make this information more actionable for you, it would help to know your primary perspective. Are you primarily interested in this as an individual investor looking to adjust your portfolio? Are you evaluating implications for a business or corporate treasury? Or are you involved with a project or startup in the crypto industry?